Imagine waking up one morning and discovering that while you were sleeping, your money earned more money. Sounds too good to be true? Well, that's exactly why millions of people around the world invest in the stock market. But here's the surprising part. Many people think the stock market is just gambling, while others believe it's only for rich people or financial experts. The truth? The stock market is simply a place where people buy and sell ownership in businesses. If you've ever wondered what stocks are, why prices keep changing every second, or how ordinary people build wealth through investing, then this video is for you. By the end of this video, you'll understand the stock market in the simplest way possible, even if you're starting from absolute zero. So let's begin. What exactly is the stock market? Think about your favorite company. Maybe it's Apple, Microsoft, Tesla, Amazon, Google, Samsung, or any company whose products you use every day. Now imagine that company wants to expand its business. Maybe it wants to build new factories, develop new technology, or enter new countries. To do all this, the company needs a lot of money. Instead of borrowing everything from banks, it can sell small ownership pieces of the company to the public. These ownership pieces are called stocks or shares. When you buy one share, you become a tiny owner of that company. The stock market is simply the marketplace where these shares are bought and sold. Just like people buy and sell houses in a real estate market, investors buy and sell company shares in the stock market. A simple real-life example. Let's make this easier. Imagine your friend starts a coffee shop. He needs 100,000 to grow the business. Instead of paying all the money himself, he divides the company into 100,000 shares. Each share costs $1. You buy 1,000 shares. Congratulations. You now own 1% of the coffee shop. If the business grows successfully, your shares become more valuable. If the business struggles, the value of your shares can fall. That's exactly how the stock market works, but on a much larger scale. What is a stock? A stock represents ownership in a company. When you own shares, you're not just buying a number on a screen. You're buying part of an actual business. If the company performs well, your investment may grow. If the company performs poorly, your investment may lose value. Some companies even share part of their profits with investors. These payments are called dividends. So investors can potentially earn money in two ways. First, when the stock price increases. Second, through dividend payments. Why do stock prices change every second? One of the biggest questions beginners ask is, why do stock prices constantly move? The answer is simple: supply and demand. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. But what changes demand? Many things: company earnings, new product launches, economic news, interest rates, inflation, political events, and natural disasters, global crises, even investor emotions. Sometimes people buy because they're excited. Sometimes they sell because they're scared. That's why prices move every single day. Who participates in the stock market? The stock market isn't controlled by just one group. Many different participants interact every day. Individual investors, people like you and me. Institutional investors. These include mutual funds, pension funds, insurance companies, and investment firms. Traders. They buy and sell frequently to profit from short-term price movements. Companies. They issue shares to raise money. Governments and regulators. They ensure the market remains fair and transparent. Together, these participants create one of the largest financial systems in the world. What is a stock exchange? A stock exchange is the marketplace where shares are traded. Think of it as a giant digital marketplace. Different countries have different stock exchanges. For example, the New York Stock Exchange in the United States, NASDAQ, the London Stock Exchange, the Tokyo Stock Exchange, the National Stock Exchange, and Bombay Stock Exchange in India. These exchanges provide a secure platform where buyers and sellers can trade shares. How do investors make money? Let's say you buy one share for $100. A year later, the company's business grows. More people want to own the stock. Now the share price becomes $150. If you sell it, you've earned a profit of $50. This is called a capital gain. Another possibility is dividends. Suppose the company earns excellent profits. Instead of keeping all the money, it distributes some to shareholders. That payment is called a dividend. Many long-term investors earn income from dividends while also benefiting from rising share prices. Can you lose money? Absolutely. The stock market always involves risk. Imagine buying a stock for $100. Later, the company's profits decline. Customers leave. Competition increases. Now investors lose confidence. The stock price falls to 60. If you sell at that point, you've lost 40. That's why investing should always be based on research, not emotions. No investment guarantees profits. Investing versus trading, many beginners confuse investing with trading. But they're very different. Investing means buying quality companies and holding them for years. Investors focus on long-term growth. Trading focuses on buying and selling frequently. Traders try to profit from short-term price movements. Investing usually requires patience. Trading requires experience, discipline, and risk management. Most successful long-term investors build wealth by staying invested rather than constantly buying and selling. Why do companies go public? Private companies often decide to become public. This process is called an initial public offering or IPO. During an IPO, a company sells shares to the public for the first time. Why? To raise money. That money can help the company expand operations, hire employees, reduce debt, develop new products, or enter global markets. For investors, IPOs provide an opportunity to become shareholders from the early stages of a company's public journey. What factors affect the entire stock market? Sometimes it's not just one company that moves. The whole market rises or falls. Several factors influence overall market performance. Economic growth, inflation, interest rates, corporate earnings, government policies, global events, wars, pandemics, technological innovation, investor confidence. When businesses perform well and the economy grows, markets often rise over time. During uncertainty, markets may decline. Should beginners invest? Many people think they need thousands of dollars to start investing. That's not true anymore. Today, many investment platforms allow people to begin with relatively small amounts. However, beginners should always remember a few important principles. Invest only money you won't need immediately. Build an emergency fund first. Diversify instead of putting everything into one company. Think long-term. Continue learning before investing. Avoid chasing quick profits. Patience often produces better results than trying to get rich overnight. Common myths about the stock market. Let's clear up a few misconceptions. Myth number 1. The stock market is gambling. Reality. Investing in strong businesses for the long term is very different from gambling. Myth number 2. Only rich people can invest. Reality. Many investors begin with small amounts. Myth number 3. You need to predict the perfect time. Reality. Consistent investing over many years often matters more than perfect timing. Myth number 4. Stock markets only go up. Reality. Markets experience both gains and losses. Long-term investors understand that temporary declines are part of the journey. Final thoughts. The stock market isn't magic. It's not a shortcut to instant wealth. And it's definitely not only for experts. It's simply a system that allows businesses to raise money and gives everyday people the opportunity to become business owners. The key to success isn't predicting tomorrow's stock price. It's understanding how businesses work, staying patient, managing risk, and making informed decisions. Every experienced investor was once a beginner. The important thing is to keep learning before investing. Knowledge is always your greatest investment. If you found this video helpful, don't forget to like, share, and subscribe for more easy-to-understand videos about investing, personal finance, and the world of money. Let us know in the comments. If you had to invest in just one company today, which company would you choose and why? Thanks for watching, and we'll see you in the next video.